All right, welcome to Talk Tickers. So today, we've got a really interesting one for you. Tenon Medical. Their latest quarter was, well, on the surface, a bit of a head-scratcher. You see a 37% drop in revenue, but then the stock jumps 14%? It doesn't quite add up, right? So let's break down what's really going on here, what the market is seeing that the headline numbers just aren't showing us. Okay, so let's really get into it, because this right here is the central puzzle. You look at the headlines, and things look pretty weak. But then you see the after-hours trading, and the reaction is, well, it's strong. It's really positive. So what on earth did investors see that made them completely ignore those top-line numbers? So let's take a look at the actual numbers. Revenue for Q2 came in at just over $500,000. And yeah, that's a major drop from last year. Gross margins also took a pretty big hit. But, and this is the important part, look at the other side of the coin. Management did a really impressive job tightening the belt, slashing operating expenses by almost 30%. And because of that, their net loss actually got better.
Yeah, I mean, a 37% drop in revenue, that's a stark number for sure. So what happened? Well, management was pretty upfront about it. They said procedure volumes were down because, frankly, they were distracted. Their commercial teams were focused on something else, something really big and strategic. And that, right there, is the key to this whole story.
And that's why, despite that ugly revenue number, the stock shot up over 13% after the earnings call. You know, this is a classic Wall Street move. The market is looking right past one messy quarter and is pricing in a completely different, much bigger story about the future. This wasn't about Q2 at all. It was all about where the company is headed next. So what was this big distraction? What was this big transformation? Well, Tenon went out and made a single acquisition, a huge strategic move that fundamentally reshapes their entire business. It flips the whole investment thesis on its head. They bought a company called SiVantage, and during the call, management even said, and I love this, they were, in their own words, a bit obsessed with getting this deal done in Q2. And you can see why. This deal brings in brand new products that are already making money, plus a really strong pipeline for the future. So yeah, sales took a temporary hit, but they saw it as a totally necessary price to pay to set themselves up for the long run. And this right here really paints the picture of that pivot perfectly. Think about it. Before this deal, Tenon was basically a one-trick pony. They had their Catamaran system, and that was it. Now they're a full-blown platform. They can go to a doctor and offer a whole menu of options for treating SI joint pain, whether it's the first surgery, a do-over, or something else entirely. This just blows their market opportunity wide open.
All right, so the deal is done. The ink is dry. And management did not waste a single second. They immediately laid out a really clear, really aggressive playbook for what comes next. And here's their immediate game plan for the next couple of months. It's all about execution. First, get the sales teams from both companies trained up on the entire product line. Second, take the best of both worlds when it comes to hospital contracts and distributors. And third, get ready for some big product launches. It's go time.
And this is the timeline that has investors so excited. These are the key catalysts everyone's watching. This quarter, Q3, we should see the full launch of their new Catamaran SE system and get new clinical data. Then, things get really interesting in Q4 with the first surgeries using the new SImmetry Plus system. That's the alpha launch, which should lead to a full rollout in early 2026. I mean, that is a packed schedule of news flow.
And that brings us full circle, right back to our original question. Why did the stock jump? Well, it's all of this stuff. The huge strategic pivot, the new product pipeline, all these upcoming catalysts. That's exactly why the market just shrugged off those weak Q2 numbers.
This really says it all, doesn't it? The market is rewarding the future potential, the pipeline, the fact that Tenon now has multiple shots on goal. That's way more important than what sales look like for one quarter while they were busy making this massive deal. Investors looked at the temporary disruption and said, yeah, we'll take that trade.
Okay, so now let's look ahead. When the next earnings call comes around, what do we need to see to know if this whole grand plan is actually working? Here's our take on it.
Number one, and this is the big one, we need to see revenue bounce back. The whole story depends on that Q2 dip being a one-time thing. We'll also be listing for any color on how the integration is going. Are the sales teams actually cross-selling these products? Is the new Catamaran SE getting traction? And finally, can they keep a lid on spending while they're bringing this whole new business into the fold? So, putting it all together, we're slapping a market perform rating on the stock for now. Look, the strategy behind this acquisition is absolutely solid. It's a game changer for them. But, and this is a big but, this is still a tiny company. There's a ton of execution risk here. They have to prove they can pull this off. So for us, it's a wait-and-see situation. But we always like to give you our outrageous but plausible trade. So here it is. If everything goes right, if they absolutely nail this integration, if revenue starts growing again, and especially if that SImmetry Plus Alpha launch in Q4 gets surgeons excited, well then the whole story changes. The company goes from being a messy turnaround to an exciting little growth stock. And if that happens, you could see the stock get a serious re-rating, maybe pushing up towards 250 or even higher.
This is not financial advice.